Good afternoon, and thank you for joining Manning and Kolkhorst CPA firm here today. I'm Kyle Kolkhorst,
And I'm Nikki Manning.
and today we will be discussing with you our findings in regards to EMLOs inventory valuation issues, as well as giving you our professional opinion about what can be done about them.
Recently, outside competition has risen, which has impacted the company's inventory, and EMLO is now expecting some of their products to be sold at a price below their cost. While EMLO's management team is in agreement that some of the inventory has dropped in value, the finance team is split over how this lost value should be adjusted on the financial statements.
As Nikki stated, because of this increase in competition, EMLO's inventory has lost some value, and therefore it can be determined that EMLO needs to apply either the lower of cost or net realizable value method, or the lower of cost or net or market value method to their inventory. The Accounting Standards Update 2015-11 provided us with the guidance that we needed to determine which method to use. According to this update, GAAP requires the lower of cost or net realizable value method to be applied to inventories measured under any method other than the last in first out method or the retail method.
The Accounting Standards Codification states that, depending on the character and composition of the inventory, the rule of lower of cost or market may properly be applied directly to each item or to the total of the inventory. So as you can see, the finance team has a choice to apply the lower of cost or net realizable method to either each individual item or to inventory as a whole.
As the directors of EMLO, this choice is very important because it will ultimately result in a decrease in total assets and net income. This is true regardless of which method is chosen. However, we believe that only one of these methods most clearly reflects periodic income. Although it is possible that others might disagree with our opinion if they can prove that EMLO's inventory items are more frequently sold individually, or if the decline in net realizable value is more significant. Because each inventory item that EMLO carries can be sold individually, the controller of EMLO wants to apply the lower of cost or net realizable value method to each inventory item separately in order to produce the most accurate determination of the total loss in value of the inventory.
On the other hand, the CFO believes that form of testing will be very costly, and the information gained for testing the inventory individually would be immaterial. Instead, he feels that because many of EMLO's clients buy multiple products with each order, the inventory seems to move as a whole, and thus he suggests the company evaluate the inventory as a whole.
EMLO's management provided us with this table depicting the current first in, first out carrying value of each inventory item or product compared to that item's actual net realizable value. We then began our investigation by looking at the total carrying value of EMLO's inventory as it relates to the total net realizable value of their inventory. We determined that the total net realizable value of their inventory was $8,000 less than their inventory's carrying amount. We also determined that the lower of cost or net realizable value for each of their inventory items, and then summed them to find that if this method was applied to each inventory item separately, that their inventory's value has fallen $45,000.
We then began to examine the CFO's claim that inventory should be evaluated as a whole instead of individually. We can see here from an excerpt of EMLO's operating statement for the year ended 2017 that the sales by product of products A, B, C, and D vary in only slight increments. And to further illustrate this fact, we've included a pie chart to show the small variances in product sales of A, B, C, and D.
Therefore, it is with our best judgment that we recommend EMLO apply the lower of cost or net realizable value method to the inventory as a whole. We base our opinion on the fact that most of EMLO's customers purchase items A, B, C, and D together frequently. In addition to this, the decline in value that will affect both the balance sheet and the income statement will ultimately be immaterial in comparison to the total amount of EMLOs assets.
Here's an excerpt from EMLO's balance sheet. As you can see, for the year 2017, EMLO had an inventory balance of $1,046,000 and total assets of a little over $9.3 million. We based our opinion of choosing to evaluate inventory as a whole on the fact that the total change in inventory was immaterial in comparison to EMLO's total assets. This slide shows how our team compared the individual items to inventory as a whole. Regardless of choosing to evaluate items individually or as a whole, one can see that either method results in an immaterial change in total assets.
Accounting Standards Codification Section 330 states, where more than one major product or operational category exists, the application of the lower of cost or market rule to the total of items included in such major categories may result in the most useful determination of income. Overall, we have concluded that applying the lower of cost or net realizable value method to EMLO's inventory as a whole will result in the most useful determination of income. Once again, in this situation, we feel that applying the lower of cost or net realizable value method to EMLO's inventory as a whole will result in the most accurate presentation of EMLO's inventory valuation and their net income.
Overall, this change will result in EMLO's net income decreasing by $8,000 due to an increase in cost of goods sold by $8,000, with the balance sheet showing a decrease in inventory of $8,000 and a decrease in retained earnings of $8,000 as well. EMLO's required journal entry will include a debit to cost of goods sold for $8,000 and a credit to inventory of $8,000.
Thanks again for joining us here today.